Hello, namaste, and a very good evening, everyone. A very warm welcome to the first session of the new financial year 2027 Equity Market Insights by UTI Mutual Fund. I'm Sonal Mittal, Product Specialist at UTI. It's been quite an eventful start to the year for markets, with volatility persisting, largely driven by global uncertainties and rising crude oil prices. Naturally, the first question that comes to mind is, should markets be worried? But perhaps the more important question is, what is the market really telling us? And that's exactly what we'll try to decode in today's session. To help us understand the current market landscape, we have with us our MD and CEO, Mr. Vetri Subramaniam, who will share his perspectives on the global and domestic markets and how investors should think about markets in the current environment. We also have our head of equities, Mr. Ajay Tyagi, who will later walk us through the investment philosophy and strategy of the UTI Flexi Cap Fund. With that, let me invite Vetri to begin the session. Welcome, Vetri.
Good evening, everybody. Delighted to have this April edition of the monthly market insight. And of course, as Sonal said, it's been an extremely eventful last few weeks. And I think today morning she actually had to redo her presentation given the overnight developments. So we can only have this event once a month, but unfortunately the news cycle changes even faster than our ability to keep track of it. But I would always say, as an investor, you need to think long term. It's really what happens over the long term which matters, and really investing calls for a lot of patience, and it requires you at some level to disconnect yourself from the 24/7 constant news feed that is constantly pounding at you. In some ways, when I look back at my own investment career over the last 30 plus years, I would say in some senses it was easier to be an investor 30 years ago because you actually didn't receive so much information overload on a daily basis. And today the challenge is about cutting out the information that you are allowing to occupy space within your brain rather than going out to seek information. But anyway, the nature of the investment game keeps changing. We will just have to adapt and learn along with it. And without any further ado, I'll just get going with today's presentation. So Sonal has put together some interesting topics for discussion. So over to you, Sonal.
Sure, Vetri. To set the context, let me start with the first question. How do you interpret the recent divergence between slowing US payrolls and still positive earnings expectations?
Sure. So those of you who watch this, monthly insight will realize that very often the first topic that we always cover in this monthly insight is something to do with the US market. And once again, what you're seeing over here is a conversation about US data. And there are essentially two lines on that chart. One is the light blue line, which you can see over there, which is the chart of the S&P 500 earnings. And the other chart that you can see is the the dark blue line, which is the chart of the US payroll. So payrolls is nothing but the labor data. Now, typically what you tend to see is that these two data points tend to move together. But if you move towards the right side, you will see that in the recent months, there is a little bit of a divergence. The dark blue line has continued to trend lower, while the light blue line is actually trending higher. So this is a divergence, and either the jobs number has to pick up again to match what the earnings trajectory is showing. Otherwise, there is a gap here, which historically, has always reconciled one way or the other. So this is something that we will have to watch. A lot of the leading indicator is suggesting a slowdown in the US economy, but earnings estimates are yet to follow. Back to you, Sonal.
Sure, Vetri. Building on that, and especially in the context of rising crude prices and geopolitical developments, what are your thoughts on how oil supply disruptions and their possible impacts across economies?
Sure. So there are some who might believe that that question has no relevance anymore, Sonal, given the overnight developments. But I would say that, once you break something, it remains broken. It doesn't go back exactly to the same situation that used to occur prior to the break. So it's useful for us to showing us. And what you've got on the chart over here is essentially the oil flows from the Persian Gulf. Persian Gulf is actually the biggest supplier of oil to the Asia Pac region. It is a very significant portion of the total supplies, and that has almost collapsed through the month of March and into early April. It roughly takes ships anywhere between about 30 to 45 days to complete its journey. So you can presume that the ships which left the Pacific Gulf prior to March have continued, the 1st of March, have continued to unload at their destinations over the last 30 days. But no ship has sailed in the last 30 days. And that is what you can see on the right side, that this is the duration of each oil tanker trip. And because those days have now sort of gone beyond that 30-day mark, there will be disruptions will show up in the month of April. Of course, journey time to the US is the longest, but to the Asian region, on average, the journey time could be 20-25 days. And then, of course, the entire turnaround time. So we do expect some impact of this disruption to show up, simply because there will be less availability of oil and therefore less production numbers in the month of April. But we can also crunch this and look at it in different ways. If you just move to the next slide. Yeah. So whom does this tend to impact? You can see the data here for various emerging economies. Very simply, these economies on the left-hand side are the economies where, they are actually oil-producing economies. And therefore, as a result, it doesn't really matter to them that oil production has declined. But these economies on this side of the equation are the economies who actually import significant quantities of oil. And therefore, as a result of that, it tends to be negative for them. Now, when the oil shock took place in the mid 70s, the US was actually a net importer of oil. Of course, in this table, we are only discussing emerging markets. But at that point of time, remember, the US was the biggest importer of oil in the world. It actually is no longer an importer. It's the world's biggest exporter of oil. And it certainly doesn't receive any oil from the Persian Basin region. But simply put, higher oil prices and lack of supply is a problem in general for emerging economies. And of course, you can see where India figures within that position, not the worst impacted, but neither is it a net exporter. Every 10% rise in oil prices impacts GDP anywhere between a few basis points to 1%. Many of the economists who have published numbers for the current FY27 are estimating anywhere between 60 to 70 basis points of damage, because remember, oil is still about 40% higher than where it was. Remains disrupted till we can get back to normal, presuming that this ceasefire eventually is the real thing. But some more data to share with you, which you can see on the next slide. This again, I believe, is interesting. Sonal, do I hand it back to you? Yeah, please.
Yeah, that was a helpful context, Avetri. Taking a step further and staying with the theme of oil and its broader implications, how do you see the current oil-driven shock playing across Asian economies, especially large net importers like China? And alongside that, how do you assess the potential impact on inflation?
Sure. So you can see that on the charts which are over here, which is why are the Asian countries more impacted by the conflict. You can see where India is positioned, which is to say that our stocks in terms of the number of days that we have to cover our demand is on the lower side. And at the same time, our oil imports from the Middle East, less than the median, but still, it is not a insignificant amount. And then, of course, countries like Philippines, Vietnam, lot more impacted because they have less stock, and at the same time, significant portion of their imports come from the Middle East. Country like China, much better placed in terms of the stockpile that it has, more than 100 days of stockpiles. Korea, almost 200 days of supplies in terms of stockpiles. And China's dependence on the Middle East is very similar to that of India, which is about 40%. China, of course, is the biggest beneficiary of the Russia-Ukraine conflict, in the sense that Russia started transporting a lot more of its oil to China via pipelines, and of course also by ship, but also significantly by pipelines. So they've actually de-risked themselves quite significantly from the Persian Basin. On the right side, you can see the energy trade for different countries. What is the energy trade balance as a percentage of GDP? So you can see that over here. Now for Malaysia and Australia, because these are actually reasonably well balanced in terms of energy trade balance. So when we say energy, we now mean all sources of energy. Australia, in fact, has challenges in terms of its access to refined fuel. But when we talk about total energy, it includes things like coal, where they are surplus. When you look at a country like India, again, we are somewhere in the middle over there. 3%, -3% is our negative trade balance on account of energy. And of course, countries like Thailand and Philippines, lot more impacted in terms of their negative imports. So net, most Asian oil countries are net oil importers. They are dependent on the Middle East. Energy imports are very significant, and therefore they are likely to be significantly impacted. Good news in a relative context is that we are somewhere in the middle. Of course, we have pain, but neither are we insulated, nor are we the worst impacted as far as this is concerned. We can also look at another context of this. I think, Sonal, we have one more slide. Yeah, there you go. And this is really looking at China. I already talked about the fact that China has been a little bit more better off when this crisis started. One, because remember, I showed you they have a lot more stock of oil which they have built up. More than 100 days of supplies is what they keep as stock with them. B, they have the pipelines which come in from Russia. That also has benefited them significantly. Also, their starting point in terms of inflation is quite comfortable. So their starting point, you can see here, actually the PPI is in negative territory, and CPI is barely above 0%. In fact, China's focus is how do we get CPI to go up. So there have been some economists suggesting that in a way, China doesn't mind fuel prices going up because it will allow them to get CPI to go up. But I would argue that that is not necessarily a good outcome. An energy shock is not necessarily a good reason to set off positive inflation dynamics. But China, in a sense, a lot more insulated as compared to many Asian countries, including India. If we move on to the next slide, and I think this is an important slide, and in fact, those of you who are regular listeners to our podcast, to our conversation on the monthly market insight, will remember that I showed you this even last time to say that whenever there has been a military conflict, you can see various military conflicts which have been charted over here. This covers everything from Russia, Ukraine 2022, all the way to the second Gulf War 2003. And you can see in every case, the initial response is for a big hike in oil prices, and typically over a 4 to 5 month period, then the oil prices decline. And of course, 12 months later, the outcomes are very different. You could look at this 2003 and say, oh my God, oil prices did manage to go up a lot after the initial spike. But I would say that was also a function of the fact that the world saw a dramatic economic recovery at that point of time. But essentially, the bigger point is that the spike in prices eventually does resolve to the downside. Now we are 1 month into this. Prices are up almost about 40%, depending on what you count as the starting point. Presuming the ceasefire we have holds, oil prices may not go entirely back to their absolute starting point of about 60, $65 prior to this crisis, because some premium might get built into risk of disruption in the Persian Basin. And therefore, as a result, it could end up slightly higher, which is not unusual, but certainly they don't hold on to their 40, 50% gains. So this is what we showed you last time. And so far, I would say with the price fall which has happened in the last few days, it is looking like some degree of normalization starting to set in. Fingers crossed, and let's hope that things stay on good keel. There is another way to look at the oil prices, and I think we have one more slide on that. Yeah, there you go. This is a slide which shows you what is the pricing of 1 month future, 3 month future, 6 month future, and 12-month future. So this blue line that you see here is the 1 month future. You can see that is trading at a massive premium to the 12-month future, right? So if you want to buy oil for current month delivery, it's $109. If you want to buy oil for 12-month delivery, it is $78. So that premium is nothing but the market estimating that we think over the next 12 months, this problem will not be as significant as it is today. And therefore, it is pricing the oil at a $30 discount 12 months out as compared to current prices. By the way, very interesting. This is the 1 month price. But if you actually look at physical deliveries, it is plus $20 at this point of time for physical delivery. So if you actually want physical delivery of oil today, it is even higher than the $109 that was prevailing yesterday. It would have actually been closer to $130. And some of the markets are extremely dislocated. For example, if you look at things like jet fuel, in Europe, the prices of jet fuel for physical delivery are even higher than the prices that used to be there in 2007, 2008, when crude had hit $148 in the futures market. And that's a function of the refining deficit, which is there at that point of time. But again, the bigger point in this chart is essentially this line at the bottom, which says that, look, energy markets were anyway pricing that if you look at this over a 12-month period, we don't think the problem will persist, and which is why the market was in backwardation and you actually saw the future contracts trading at a discount. So I think we can move on to the next discussion point, Sonal.
Yeah. But we have also seen quite a divergence in currency performance across emerging markets. So what factors do you think are driving this divergence? And importantly, what could this mean for India's outlook?
Sure. Very interesting point. And I must say that when you look at this chart, it is a bit of a shocker to see India at the bottom of this. So it means we are the worst performing currency against the US dollar. Largely, these are emerging economies from across the world. And of course, these are all oil importing countries, INR, Philippines, this is Japan, this is Korea. So these are really the worst performing currencies. Now, typically in the past, when we talk about the rupee, we talk about the trade deficit, we talk about the current account deficit, because these are the numbers that we talk about in the context of the factors that would cause the Indian rupee to depreciate. And by the way, when you look at this chart, what you'll see, best performing currencies, these are all energy exporters. Mexico, that's Australia, and that's Brazil. So the best performing currencies in 2026 year to date are the exporters, and these importers are worst impacted. Now, typically, the prism that we would always use is to discuss things like fiscal deficit. We would discuss things like oil prices, the trade deficit. I think this time the culprit actually is coming from somewhere else. What is that somewhere else? You will see that on the next slide. Yeah. So this is really the problem. We are used to the fact that India normally has a current account deficit. If you look at India's current account deficit, actually for the year FY26, it is comfortably within 2%. 2% is the level of comfort that the RBI normally indicates. In fact, I think we'll be closer to 1.5, 1.6%. Now, how do you fund this deficit? You fund it with capital inflows coming into India. India has been the recipient of large capital inflows from all parts of the world, including FDI and FPI flows. The challenge in India has been that FPIs have been significant net sellers for 2 years in a row. This is the FII selling which has happened in the market in FY25 and FY26. So they have been taking out capital. Not only have they taken out capital, if you compare India to all the countries you see in this list over here and compare the sell off as a percentage of market cap, India is effectively being the outlier. So the reason for this poor performance of the rupee in the last 1 year, I would submit for a change, is not because of the current account or the trade account. It's because capital inflows into India have been soft. What you saw on this slide is the FII outflow. But interestingly, when we go to the next slide, what you will see is that not only because of the FII outflow, but you combine that with the outward FDI and repatriation. What does that mean? Outward FDI is the FDI that Indian companies are doing. Repatriation is nothing but large global multinationals pulling back capital from India. Sometimes they could be dividending it back, and in other times they could be getting listed in India and taking the proceeds of their listing back to their home territory. Now, when you look at this chart, what you'll see is historically, this number has always been positive for India, right? There have been times like 07, 08 when we were hugely positive. In the GFC, we briefly went negative. And even during the taper tantrum, actually, this number stayed as a positive number of GDP. In the last 2 years, this number has actually declined, and capital flows as a percentage of GDP have actually gone into the negative territory. So this, to my mind, is actually the big reason why the rupee has ended up becoming such a big underperformer relative to other geographies, a very different reason compared to what we have seen in the past. So yes, I know in the past we've said we don't worry so much about oil prices because that's getting funded by our net software exports to the rest of the world. That continues to be true, but our capital account, which we always depended on for inflows, have actually ended up becoming negative, and that's the reason why the rupee has experienced this additional pressure.
Sure, Vetri. Let's zoom out to the broader Indian markets. How are markets shaping up in terms of performance, earnings, and valuations? And what does our equity valuation index indicate today?
Sure. I think, just from a interest point of view, it's interesting to see what typically happens to earnings forecast. This is for the MSCI India, so that's about 100 plus companies, not just the large caps. And you can broadly see that every time there has been a crisis, that was the Russian crisis, 2011, the Libya civil war, which also impacted oil, 2012, the EU oil embargo on Iran. In each of these times, there is a broad decline in the trajectory of earnings growth forecast for the 12-month forward period. We're not rolling it forward, but the 12-month period, what was the decline in the revisions? So on average, earnings forecasts tend to be cut by about 7%. That's at about 93, or you can see over there. So a 7% cut is what has typically happened. That's the median cut. So this is what should be the number that we keep in mind. Right. We can just run through some of these. This is just to sort of reiterate. This is the 1 year performance of different market segments. You can see over there that the Nifty mid-cap continuing to be a standout performer relative to other segments of the market. On a 1 year basis, the last 1 month, actually, small caps have held up quite well into this sell-off, as a result of which on a 1 year basis, they are only marginally behind the large caps. On a 2 year basis, the mid caps remaining the best performing segment of the market, and the large caps running slightly ahead of the small cap segment of the market. So that's what the data looks like over a 1 year and 2 year period. Slight advantage for the large caps, but it's really the mid caps which have done the best. Moving on. Yeah. So this is the current earnings expectations. March 26 earnings are going to get reported now. This number has actually been cut. So you're now looking at only 5% earnings growth in 2026. This number used to be much higher earlier. So some of the impact of the Persian Gulf Iran crisis, I think, has already started getting reflected in the numbers. And therefore, because of the cuts there, earnings growth expectations for March 27 remain 12%. But if you look at the absolute number 1276, this has actually declined slightly. So I would say some level of earnings cuts have already filtered in, but perhaps we will have to wait and watch, because I think you will see some more cuts, particularly this April to June quarter is likely to see more cuts in EPS, is my sense. Remember, you also saw in the previous slides that typically we end up with a 6-7% cut in EPS from the starting point. So we have not yet reached that point. But again, lots of moving parts here, so let's not get ahead of ourselves. Going on to the next slide. Yeah, this is just the trend of companies with more than 10% year-on-year growth. Slight improvement which happened in the March quarter. We'll see what in the December quarter. We are yet to get the data for the fourth quarter. Earnings season will start shortly. Let's see where it ends up. But my sense is this could be flat in terms of the trajectory, or it could even show a slight pullback compared to what was there in. But not as buoyant as it used to be in FY24 when you look at this period. Moving on. Yeah, this we are now looking at the equity markets and valuation. I won't spend too much time on this. Simple point to make: Nifty on trailing PE is in the white zone, which means it is in the fair value. Even on forward PV, it is now in that white zone, which means it is in the fair value. If you go to the next slide, which is even more interesting, because price to book, I think, actually has a very strong element of not running into troubles of what growth trend lines look like. Very clearly over here, this is not just in fair value, in the white zone, it is below the average line. In fact, it is almost pretty close at the low point we saw maybe a few days ago, pretty close to that yellow line. So this is one indicator which very clearly trailing price to book. It shows up only sometimes in terms of being cheap and expensive, but a very, very reliable indicator which told us in recent times market has become a lot more attractive, much closer to the cheap zone. But moving on, maybe Sonal, we can, yeah, so there we are. That's the Nifty 150 mid cap on the left hand side, trailing price to book. Still expensive compared to the large caps. Same for the small caps. But the good thing is that the small cap has now at least come back within the white territory. So, yes, small caps on aggregate are bare within the fair value territory. Not true of the mid caps, which are still sitting at the upper end of the expensive zone. When you look at all three segments, of course, it's the large caps which are the standout in terms of having dropped below the long-term average. We can also look at the next slide, which shows you what is the comparison between the 10-year bond and the Nifty earnings yield. Main point to remember is that this is the long-term average, which is about 0.94 minus 0.94%. This is the closest that the indicator has come back towards that trend line. So very interesting that even this indicator at the recent lows came back to a zone where equities start to look favorable. Of course, at UTI, we run the equity valuation indicator. We'll jump ahead to that slide. Yeah, this is our proprietary equity valuation indicator. Again, very clear, unambiguous message. This is back in the green zone, which is actually a zone in which you can increase equity allocation. The proprietary equity valuation index that we use looks at price to book, it looks at price to earnings, it looks at dividend yield, and it's a composite. So based on all of this, this is what it is saying, that this is a zone in which you can increase your equity allocation. And in fact, we'll look at this in the next two slides, because I think it gives you a good perspective of how the model works. But just to give you a sense of what can an investor who invests in the green zone expect, you'll see that on the Next slide. So investors who invest lump sum when the market is in this increased equity allocation zone, 30% of the time the market is in that zone. 57% of the time the 1 year return is positive, 12% or more, and negative return, there is only a 7% chance of a negative return. So I would consider these to be very favorable risk reward setup for investors. There is no certainty in investing, but the risk reward has to be favorable. To my mind, this is a very favorable risk reward, and that is what the indicator was showing. This model is what we use in all our hybrid funds which do active asset allocation, and you'll be able to see that on the next slide. So if you see the next slide, this is the movement of the Nifty index, the PRI index. March 25, this is where it was a year ago. This is where it was in February. This is the point it came down to on 31st of March. And because all these three funds of ours use the equity allocation model, you can see that into the fall, they actually raised their equity asset allocation. And the reason they are doing that is that they are in a disciplined fashion responding to what the UTI proprietary equity valuation model is telling them. The reason why each of these numbers is differently positioned is their min and max equity allocations are different, so they are operating within the range. But most of them have now come closer to the upper end of the range, certainly above the average as compared to where they used to be earlier. Finally, on the last slide, this is really just a summation point of everything that I've talked about. I won't run through the first part of that. In a sense, we've covered it. Main point to make, the in-house equity valuation index is now in the increased equity allocation zone. Investors should prioritize asset allocation and risk management. The reason I continue to say that is that we are still in an environment where geopolitics has become a lot more volatile, stemming both from US administration. Many things may have changed, but the administration in the US has not changed. So you'll continue to see geopolitical led friction, in my opinion, in the world. But you should be looking to increase equity allocation in this zone. That's what a lot of our asset allocation strategies have done. Value has had blinding performance compared to quality growth over the last 5 years. We've said this for more than a year, but we believe the odds are favorable for mean reversion to take place now, and our favored segment of the market remains large caps just based on relative valuations. So I'm going to pause over here and hand it over to Ajay Tyagi, our head of equity. He's also the manager of UTI Flexi Cap Fund, but he's also leads the entire equity team at UTI, including our analysts, our fund managers, who run very diverse strategies across the entire range of spectrum. He also is responsible for our passive equities and our quantitative equity practice. So he's an authority. He's got a great amount of experience, started his career all the way back in 2000 in UTI and grown to this position of now being the head of equity. Over to you, Ajay, and look forward to hearing your thoughts and views.
Yeah, thank you, Vetri, and thank you for sharing your insights on the economy. I'll quickly run a few thoughts around the Flexi Cap Fund to start with, and obviously then we'll take questions in the end. So yeah, Sonal, over to you.
Yes, sure, Ajay. To begin with, how would you describe your investment philosophy and portfolio strategy for UTI Flexi Cap Fund?
So Sonal, UTI Flexi Cap is basically built around these three key pillars that you see in front of you on the slide. We start with quality. That's always the starting point. And for us, quality signifies the ability of a business to generate strong return on capital and to create economic value. So in a way, the philosophy is built around how the business would create and deliver value in the coming years. Is the business strong enough to generate strong cash flows and therefore have a strong balance sheet? And is it meeting the very fundamental principle of creating return on capital employed substantially higher than the cost of that capital? So it's basically a strategy which is oriented towards the potential of the business rather than looking at which sectors or which stocks can do well in the coming quarters. Now, with quality actually being solved for at the first stage itself, we then try to solve for businesses that can continue to grow better than India's nominal GDP growth or better than India's earnings growth potential, as showcased by the broader indices like Nifty 500 or Nifty 100 and so on. So we don't stop at quality. We want to solve for growth as well, and here we try to look for businesses that are part of an industry which is at a very, very sunrise stage today, at a stage where the penetration of that industry is very, very low, and therefore the potential for a multi-decade kind of growth is very high. Now, therefore, in the final submission, what we try to look for are businesses that are displaying both of these characteristics, which is basically quality along with growth. Look for any stock selection and portfolio construction, valuation has to be one of the key factors. It's just that for us, the conversation never starts with valuation. We don't look for things which are cheap or which are mispriced or which have seen a dislocation in terms of the value price equation. For us, the starting point is always understanding the potential of businesses and whether these businesses themselves can create economic value or not. But certainly, valuation is the third most important step in our philosophy. We try to solve for businesses that look attractive from a price to cash flow perspective. We also look for the right valuation of a business by discounting their future cash flows to the present. So since we deal with high growth businesses, many a times these growth businesses look expensive from a 1 year, 2 year forward perspective. So to do justice to them, we have to look at their growth potential over the next 20 years and then discount back their earnings and their cash flows to the present day. So yeah, that's a condensed version of our philosophy for you. But there are a few other facets, which are important in our stock selection and portfolio construction. We are bottom-up driven, so we don't look at what's happening in the economy to construct our portfolio. We look at things from a bottom-up perspective. So like I just mentioned, we would always try and get excited by the potential of businesses well into the future, by which I don't mean the next 1 or 2 years, but by which I mean the next 5 to 10 years. And we try to understand the microeconomics of these businesses. How are they placed in terms of the competitive intensity within their respective industries? Is it a duopoly? Is it an oligopoly? Or is it, let's say, a perfect competition, which means that the ability to generate high ROCs would be very limited? So that's what we try to look for in our businesses. We have a very low portfolio turnover ratio. We have a slide on that subsequently, so I'll discuss this a bit later. But one of the key things which I do want to mention at this stage is that although the portfolio has a very low portfolio turnover, but it has a very high active share. So what we like can be significantly overweight versus the benchmark. What we don't like can be absolutely zero. And that's true of multiple sectors where we are having zero holdings because we don't think that we can find companies which display the kind of economic attributes that we wish to have. So yeah, that was an answer to our philosophy. Yeah.
That's helpful, Ajay. Building on that, markets often go through phases of style rotation. How should investors think about the rotation between quality and value styles?
Sure. So Vetri just touched upon this very, very briefly when he said that value has had a very strong run in the last 4 or 5 years, and style rotation is inevitable. In fact, I'm just reminded of that very old saying that death, taxes, and reversion to mean is the only certainty that exists in life. And reversion to mean is a very, very I would say, potent principle of the stock markets, of all financial markets, and certainly the stock markets as well. And here again, after a very long run of outperformance shown by the value style, we do believe that the quality style should now start to come back and the value style should take a pause. By the way, what you see in front of you is the value versus the quality cycles all the way back to 2006. And on a 1 year basis, we see here shown in the blue shaded area the phases of value outperformance, and equally in the blue shaded areas the phases of quality outperformance. As you can very well surmise after looking at this chart, we have gone through a prolonged phase of value outperformance starting 2021. Yeah. If we go to the next slide, it's the same data, but from a 3 year rolling perspective this time. Of course, the 1 year rolling data, gives a little more noisy kind of output. But if you try to smoothen it out by looking at 3 year rolling outperformance or underperformance of one factor versus the other, this is how it looks. Once again, on the extreme right-hand side, starting 2022 this time, because you're talking about 3 years instead of 1 year, value has seen a massive outperformance. Compare the recent yellow shaded area to the previous yellow shaded areas, and you'll be able to appreciate the magnitude as well as time frame that for which the value factor has outperformed this time. Yeah.
That's a very helpful perspective on style rotation. Taking a step further, under what kind of market or economic environments quality is expected to do better?
I think that's a great question, Sonal. And, we've done some data crunching here. And what we've done is we've picked up a 20-year data and we have picked up 4 indices. Basically, we've picked up the quality index and the value index. This is basically to gauge the style rotation and basically which style does better under which market conditions. Equally, we've also looked at the large cap versus the mid cap equation. So we have taken the broad market index Nifty 500 versus the mid cap index. And we've taken daily values of all of these 4 indices starting 2005. To be precise, 1st April 2005. And basically, using this data, and by the way, there are 4,938 such observations between 1st April 2005 to 31st March 2026. So on a 1 year basis, we have calculated the returns of all of these 4 indices and, bucketed them into 3 different buckets, which I'll just explain to you. But we also have 4,438 observations of 3 year rolling returns of each of these 4 indices. Once again, we have bucketed them into 3 different buckets. I'll explain which are those buckets. And the last one is the 5 year rolling returns. We have done a similar exercise, just like I explained for 1 and 3 years. Now, coming to the 3 buckets, which signify the market mood or different scenarios of the market, like you just asked. These are basically the bullish phase, the bearish phase, and the more normative phase. We've defined the bullish phase as one where markets are giving 15% returns or higher, not just over a 1 year period, but all the way up to 3 years and 5 years. You can imagine this certainly is a fairly bullish scenario where higher than 15% returns go on for 5 years back to back. Equally, we have defined a bearish scenario as the one where markets are negative, once again, not for 1 year or 2 years, but all the way up to 3 and 5 years. Battery showed some data where over a 1 year period, we are negative. Just imagine if this goes on for 3 years or 5 years, how bearish would that sentiment be? But obviously, the more normative market scenario, and that's where typically the market ends up being more often than not, is the 0 to 15% range, which is what we define as the more normative scenario. Now, here is the final result, which will possibly answer your question. Whenever markets are bullish, whenever there is a risk-on mood that's happening in the market, whenever people are loving to take risk and they're looking at finding opportunities where there is a massive re-rating potential or businesses which will actually, more than the compounding of earnings, will witness a massive re-rating of their valuations. I think in this time, as it very clearly shows, the value factor does very well, and also mid caps do better than large caps. And this is a scenario which is shown in the last row on this table, which is higher than 15% returns, or a bullish scenario across the time periods of 1 year, 3 year, and 5 years. You can see that the value factor does significantly better. By the way, we have been under one such period starting 2020 till 2025. And that is why we have seen the value factor doing very well. The other extreme, obviously, is a risk-off event. Markets are bearish here, less than zero, so negative returns basically. And during such time periods, investors want to be very sure-footed. They want to invest into businesses where there is downside protection. They're not looking at re-rating. They're looking at certainty. They're looking at strong balance sheets. Once again, it's only obvious that during such environments, the quality factor will do very well, because that's where people are wanting to, tilt their portfolio to. As it shows here, during 1, 3, and 5 years, the quality factor does well. But the interesting data point is that when the markets are more normative, when investors are neither too excited and ebullient about the markets continuing to go up year after year, at the same time, they're not too fearful about even the bottoms falling off. That's the time, once again, when the quality factor does well, because here investors are looking at serious compounding of earnings. They're neither looking at capital preservation, nor are they looking at re-rating of their multiples. They're looking at the earnings compounding, driving the stock prices and generating wealth. And therefore, once again, the factor that comes into focus is the quality factor. So I would say, yeah, I mean, during bullish market conditions, just to summarize this for you now, Sonal, during bullish market conditions, it is the value factor and the mid caps which do well. But during bearish market conditions, outrightly, or more normative market conditions, people start to look at the quality oriented businesses. Yeah. Very quickly, this slide is basically to showcase where do we stand, in terms of our strategy versus, the markets and versus the value factor. On this chart at the top, you see the classic quality versus value rotation. I did show this to you in a previous slide. This is on a 3-year rolling basis. But we wanted to compare this with our own strategy versus the value strategy. Why we have put this here in front of you on this slide is that look at the massive correlation that the two charts have. In fact, you would call out the charts to be exactly the same. It basically means that we have been, very, very style pure, despite the fact that being quality focused has hurt us in the last few years. And just like quality has underperformed value, our own fund has underperformed value. But equally, as quality comes back into action, like in the previous time periods, the green shaded areas that you see on this slide, our fund should also be able to take a ride and create alpha, cover up for the underperformance of the previous few years, and hopefully give you some more, basis our continuing focus to remain pivoted to quality and not, diluting that focus or diluting the portfolio. Yeah.
Yeah. So Ajay, from a long-term wealth creation perspective, how does sticking to a single investment style or style discipline help investors create wealth over time?
Sonal, I think let's start by looking at this very, very famous and powerful quote by Charlie Munger. The big money is not in buying or selling, but in waiting. And I think this is a very profound statement. If you look at some data on the next slide, you would see that indeed holding on to your style does work. So let's look at data since 2011 till date. Every year there is one style factor which is doing well. So we have made a comparison between quality and value. In certain years quality does well, in certain years value does well. Sometimes 3 to 4 years back to back, one style does well and the other side's style suffers. But let's look at the extreme rightmost columns, which is basically the annualized return since 2005. Despite this rotation, what is extremely supportive of remaining style pure and sticking to what you're doing for the long run is this data, which shows that both the value and the quality indices are giving 17% annualized returns, and both of them, by the way, are outperforming Nifty 500. So there is absolute merit in staying focused and staying true to your style, while of course the markets will change their moods. But if you don't change your portfolio, you would be able to actually ride on the change in style whenever that happens, and therefore, like I said, recoup the underperformance of the previous years and generate outperformance eventually. Yeah. By the way, one of the other things that you can look at from our portfolio is the fact that it has a very low turnover ratio. So once again, like I mentioned, we remain true to our style. We haven't moved the portfolio too much. Of course, there have been some new ideas that keep getting added every year, but from a style and positioning perspective, we've remained committed to that. Yeah.
Sure, Ajay. For our investors and viewers to better understand the portfolio of UTI Flexi Cap Fund, how are the current stock and sector exposures positioned, and what is driving the key overweight and underweight calls in the portfolio?
Sure. So what you have in front of you are the top 30 stocks. We do have, as I'll show in the subsequent slide, a very sharp focus on the consumption sector, both consumer services and consumer durables. You can see many names on this slide, like Eternal, like Titan, like Avenue Supermarts, like InfoEdge. These are all the typical consumer names that we are backing and that we basically are truly focused on. We are also, by the way, positive on the IT sector. We have a slight overweight there because we truly believe that the IT sector is going through a massive dislocation. But we truly believe that this is not the first time that the IT sector has been written off. But in the bargain, we are getting many of these businesses at very, very cheap valuations. By the way, on the next slide, you can see how our positioning is from a sectoral perspective. On the left-hand side, you can see the key overweight stocks: Bajaj Finance, Eternal, Avenue Supermarts, InfoEdge, and Titan. The key underweight names are Reliance, L&T, State Bank of India, Infosys, and Axis Bank. Now, on the sectoral breakup, like I mentioned, consumer services is almost a 13% overweight. We are very, very positive on consumption. Consumption remains the bedrock of the Indian economy. If India has to do well and continue growing at 6 to 7%, consumption will keep improving. By the way, as per capita income improves, discretionary spending will keep improving. That's been the trend within India over the last 20 years, and that's been the trend we have seen in other emerging markets as well. So that's driving our very strong focus on both consumer services and consumer durables, the two big overweight sectors for us. Yeah.
Yeah. Ajay, taking that forward from a fund characteristics perspective, could you highlight some of the key fundamental attributes and risk ratios of the fund?
Sure, Sonal. So what you see here are the key attributes. Let's consider the growth first. Look at the performance in terms of the portfolio revenue growth, and we have compared each of these vectors to the benchmark. And we have taken BSE 100 because of the quality of data coming from the BSE 100 companies is much better than doing this analysis on the entire 500 companies. But directionally, it would be very, very similar. So you can look at the outperformance that we've been witnessing in terms of the revenue growth potential of our portfolio. Now, while the last 3 years in terms of the fund performance may have been poor, but in terms of the fundamental attributes of outperforming the benchmark on revenue growth as well as profit growth has been as solid as ever. We have outperformed both on a revenue and an operating profit basis with somewhere between 5 to 8%, all the way back from 3 years to 10 years. Since it's a high quality portfolio, it is expected of us to show better return on capital or better return on invested capital. And that indeed is the case, as you can see on the third key factor, comparing it to the benchmark. And last but not the least, a high quality portfolio should also have a strong balance sheet, as reflected in the net debt to equity number being negative, which means it's a net cash balance sheet rather than having any debt. From a risk perspective, if you see on the next slide, the portfolio once again measures up very well. While it may have underperformed, but on a true risk metrics, look at the standard deviation of the portfolio against the benchmark. Once again, all the way back to 10 years. And in every time period, you can see that the valuation, the standard deviation is lower. The other way to look at the volatility of the portfolio is to look at the beta. Beta consistently has been between 0.8 to 0.9, once again showcasing that it's a portfolio which is not moving around and jumping around too much. Yeah.
Thank you, Ajay, for diving into the details of UTI Flexi Cap Fund. Let me bring Vetri back into the conversation. The floor is now open for audience questions. You can post your questions in the given link. Till then, let me take some questions that we have already received. Vetri, my first question is routed to you. FY26 returns have turned negative amid geopolitical tensions in the West Asia. How would you sum up the year gone by?
Well, I'd sum up the year gone by as one in which geopolitical risk came to the forefront. And I would say it is now visible with the benefit of hindsight that actually this pattern of heightened geopolitical risk has actually only been going up maybe even over the last 6, 7 years. Maybe we've experienced it more in the last 2 years, particularly with the change in administration in the US. But now, when you look back, the pattern is clear that geopolitical risk and instability has gone up quite a bit. But I would still say that, market behavior and responding to last 1 year return being negative. I always say this, markets don't care for your birthday or financial year or calendar year. Markets have their own rhythm. They will respond to their own things. I have my thumb rule for this is that in any given 12-month period, the market can crack 10 to 15%. In any given 1 year, over a 3 to 4 year period, the markets do crack 15 to 25%. And once every 10 years, the markets do crack 30 to 50%. Go back and look at many markets over the last 25 to 30 years, you will see this pattern is pretty much true across equity markets. So there's nothing unusual about the market delivering no return over the last 1 year. I think investors need to approach equities with a minimum 5 year or plus horizon. And I think, the data shows that once you remain invested for those periods of time, the returns have typically tended to come to investors. And therefore, there is a reason why equity investors should always have a slightly optimistic view of how things pan out. I will only guide investors back to the table we showed earlier, Sonal, which shows the probability of getting more than a 12% return, 57% probability when you invest at cheap valuations. And in the past, we've also shown what is the typical return you can expect when you remain invested on a 5 year rolling basis. And that is very much risk reward favorable for long-term investment. So that's the way to think about it.
Sure, Vetri. So with the pause of this US-Iran conflict for 2 weeks and oil prices expected to ease, will the high-risk premiums and added shipping costs through the Strait of Hormuz affect India's oil prices?
Without doubt, Sonal. And as I said earlier, remember that price that you are seeing for Brent crude or for WTI crude, which is what we all track, that's the futures price. Actually, the price for physical delivery has been higher by $10 to $15 in the physical market. So there is certainly going to be a period of 2 to 3 months where everybody will be paying that higher price. And secondly, it will take some time. Remember, we talked about the time it takes for the tanker to go around and come back. So it is going to take some time for the logistics to fall back in place. Finally, there will continue to be some element of a risk premium built into the price that, hey, this is only a ceasefire. How do we know this is durable? What is the risk that once again there will be some disruption? Economic actors will choose to run with higher stock as compared to what they were doing earlier because nobody wants to take a chance of being caught on the wrong side if a flare-up were to happen again. So all of this is likely to leave the prices slightly higher than where they were before the crisis. So if 3 months ago your base case was $60 to $70 of crude oil prices, today, I would say that range is maybe higher by $20. Honestly, I'm pulling a rabbit out of a hat. I don't know whether it is 20, but it is higher. And directionally, that's the way to think about it, that there will be some amount of risk premium which is likely to persist in the market. If you remember the chart we talked about, over 12 months, some of the risk premium does erode, but do presume that for the current year, oil prices will be slightly higher.
Sure. Ajay, my next question is for you. UTI Flexi Cap Fund has seen some underperformance. You mentioned about it during your presentation also. What has driven this, and how should investors view it going forward?
Well, like I explained, in response to your question about style rotation, basically, first of all, the UTI Flexi Cap Fund is pivoted towards quality, and we've been, very focused and positioned around building a portfolio of high quality businesses. Unfortunately, quality has been out of favor for the last few years, and I should say that it's slightly unusual for one style to actually see such a protracted period of outperformance. And value as a style factor has seen a protracted period of outperformance, which is absolutely bad news for someone who's constructed a portfolio, based on the quality factor, and that has led to a sharp underperformance for our fund, the UTI Flexi Cap Fund. So, like I mentioned, reversion to mean and rotation is something which is a very potent principle of the market. We do see reasons for the value factor taking a pause and the quality factor starting to do well. And should that happen, our fund, is very well positioned to ride on that phase of quality outperformance. So that's the outlook that I can share with our investors.
Sure. Thanks, Ajay. Vetri, coming to you. With persistent FII outflows and slowdown in primary market activity, how do you see the implications for Indian equities?
Interesting question, but again, I would say, I have in the long term believed that when you look at the sort of outcomes that investors experience in equities, they are better correlated with starting valuations rather than with which investor in the market is doing what. These are impossible to say at which point of time whether domestic will be buyers, FPI will be buyers or sellers or vice versa. So I would say better to be guided by what the valuation cycle is telling us. The valuation cycle is giving an unambiguous answer that today the risk reward is in favor of investors who are willing to deal with some risk. I'm not saying all risks have gone away, which is why we are saying still continue to think about asset allocation and risk management in the current environment and stagger your investments.
Sure. Thank you, Vetri. Ajay, coming to you. Given the fund's tilt towards quality and consumption, how do you see the outlook for consumption theme amid rising inflation risk?
So that's a real risk, and of course, we are, we've started confronting that risk only in the last few weeks. Of course, the ceasefire is giving us certain amount of hope that this would be a short-lived phase of a few months or a couple of quarters, after which normalcy will return back to the major economic vectors that Vetri discussed: current account, fiscal account, and also inflation. By the way, I mean, our bullishness on the consumption theme is predicated on the fact that in an economy where per capita income is just about $2,500, the penetration of different discretionary categories in the consumption basket ought to be very, very low. When we start comparing different, facets of India's consumption basket to other emerging markets, we do realize that how low the penetration here is, and rightfully so, because we're talking about an economy with a per capita income of $2,500 versus, let's say, $8,000 to $10,000 for other emerging markets. And that's driving our fundamental bullishness around the fact that this is that part of the economy which will continue to do well in the coming years and decades. Once again, India is driven by domestic consumption. If you are bullish on India's growth, then I would say you have to be bullish on the biggest constituent of that growth, which itself is consumption. Yeah.
Sure. So,
Sonal, if I
Ajay,
could just add,
Yeah, sure.
We put on the
Please.
consumption piece, but you were asking Ajay about earnings. And that was one of the points I was trying to make in those valuation slide. That's the beauty of the price to book ratio, because it is indifferent to what is your trailing earning, what is your earnings forecast, how much can the earnings forecast come down. Price to book is just telling you what are you valuing the assets at. If you are willing to take a call that these assets can generate a good return for those who are managing that capital over long periods of time, I'm referring to the entrepreneurs and professionals running the companies, then that is a measure of what are you paying for those cash flows. That is telling you that you are in the attractive zone. You are actually borderline cheap, certainly well below fair value. And therefore, really, to me, when price to book gives that signal, you can keep debating how much to take the earnings forecast up and down, but I would say that signal is telling me that is noise. The only time to worry about price to book is that if you are over leveraged, but all the data tells us there is no over leverage. So then, I'm just saying, you sometimes have to look at what is the most important variable in the current context rather than relying on a specific set of tools.
Thanks, Vetri, for adding those value points. Ajay, in the interest of time, I'll take two more questions. So first question is for you, Ajay. How are you navigating volatility in the portfolio, and what gives you confidence in your current holdings?
I think that's a great question, Sonal. And what I would say is that the reason that we have built a portfolio around quality businesses is basis the fact that we are preparing for any eventuality. Look, you can't predict the future, but you can prepare for the future. That's once again one of those timeless lessons that all of us have learned in the financial markets. Prediction is difficult, but preparation is possible. And what we've tried to do in the UTI Flexi Cap Fund is to have a bunch of businesses which are, not only resilient, not only the leaders in their respective industries, but essentially have strong balance sheets which can withstand any amount of exogenous volatility and be right up there, and in fact act as consolidators of weaker players in their own respective industries whenever times like these happen. So essentially, we don't need to do anything right now. We don't need to get unnerved about, some of those weak businesses in our portfolio which may face pressure when the environment is bad. In fact, this is the phase and this is the period of time when we feel that these businesses outshine the others. Yeah.
Thanks, Ajay. Vetri, the last question is for you. In today's uncertain environment, how should investors approach allocation? Stay cautious or stay invested?
See, those terms are too generic, Sonal. I would just say that I think, as I pointed out earlier, I think we are in a slightly different era where geopolitical shocks are more the norm rather than being absent. And I think in these kind of scenarios, investors need to keep in mind that they are not trying to maximize their financial outcome. They are trying to secure their financial goals. And the best way to do that is to practice disciplined asset allocation in your own overall, portfolio structure, whether you're doing it yourself, you're working with a advisor or a wealth manager, whatever that might be. But you need to have that balance of asset allocation to enable you to manage that volatility. So I would say, think about this from an asset allocation perspective. Stay within your goals. Don't get overextended in one direction or the other. This is the wrong time. Certainly, I would say, after you've seen a sell-off in the market is the wrong time to get cautious. Just as 2 years ago, when the market rallied very sharply, was the wrong time to get ebulliently bullish. So managing that asset allocation, thinking about how to get to my destination rather than maximizing or rather minimizing the time in which I get to my destination is really the secret to a good night's sleep and securing your goals in the long term.
Sure. Thank you, Vetri and Ajay, for those valuable insights and perspectives. To sum up, while the near-term environment continues to be influenced by global uncertainties and evolving macro trends, markets are also reflecting underlying resilience and long-term opportunities. As always, staying disciplined and focused on fundamentals remains key. With that, we come to the end of today's session. We hope you found this discussion insightful and useful in navigating the current market environment. Thank you all for joining us today and for your continued trust in UTI Mutual Fund. Have a great evening ahead. Thank you.
Thank you.
Thank you. Thank you, everybody.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.